A National Bureau of Statistics spokesman said the economic environment remains complex and grim.
It is. Where isn't it complex and grim globally?
Is that a good summary of China?
I think it is. I think the first positive thing to note about the GDP release is obviously that shift towards the consumer as well. So we are seeing, at the margin, further rebalancing within China. But I think what's also important to note is that we've also seen a significant improvement in industrial profitability over the first half. First quarter in particular, we saw a huge amount of credit being pumped into the system, less so actually in the second quarter compared to the impact to GDP. But in a context where we've seen things like Angang Steel, Manshan Steel produce the best quarterly profit they have since 2009, this is actually really positive indications. On the credit side of things, importantly as well, when we look at PPI, so the Purchasing Price Index in China, so inflation for the industrial sector, we've seen the greatest improvement since 2009. So effectively, every marginal new piece of credit that's extended to the industrial sector is less costly in real terms now than it has been for about 7 years.
So if prices turned a corner after 4 years
Certainly.
of producer price deflation?
Certainly,
definitely.
And that's a huge thing to be looking at, particularly when we think about capacity utilization in China. So that PPI improvement and convergence with CPI tells you something about the utilization of capacity. That's hugely important just now in the current environment, where actually a lot of this improved profitability, and particularly in steels like Angang and Manshan, has come through cost outs. We've seen just over the last 2 days, Baoshan Steel in China commit to about 25% reduction in their capacity out to 2018. You're seeing a significant amount of SOE reform happening in China just over the last 3 weeks. So capacity utilization seems to be at the margin improving, which is a hugely positive sign for the reform environment for China going forward.
And is the goal there, is it achievable, double the economy from 2010 to 2020, maintain this sort of 6.5% growth level through then? Is it achievable or not?
It's obviously very difficult in the current environment, and particularly globally when you're looking at things, the outlook is more opaque as I've ever seen it. One of the things that we at Northern Trust are looking at the moment is looking to invest in companies that have sort of sustainable competitive advantage over long periods of time, that have an ability to generate high cash returns and compound those cash returns, importantly. And hopefully these are the kind of companies globally that can perform irrespective of the global environment, I think. But when it comes to China specifically, I think they have the ability, they've certainly got the tools with which to buffer themselves for any potential shocks, and it remains to be seen whether or not they continue down the reform.
What's the yuan policy right now, Douglas? I think we're all a bit confused. Against the dollar, we're at 6.68.
Yep.
They're obviously happy to let it drift lower against the dollar.
I think so.
As Tom was saying, it's drifted lower against the basket too.
It is.
How much lower? To what extent? How worrying is that? Might we see another run on reserves and outflows, etc.?
I think there's a couple of things to note on that. One is that we don't actually think that the yuan is being used as a policy tool necessarily. The impact to a weaker yuan doesn't actually have a huge impact to the Chinese economic environment, particularly on exports, as people think it is, particularly in an environment where we are seeing rebalancing, where in actual fact, over the long term, a stronger RMB is better for domestic consumption than a weaker RMB. So the RMB at the margin at the moment is being driven by outflows rather than policy. And it's important to note as well, with those outflows, that the Chinese government are failing to sterilise those outflows. So I think they're happy with a slightly weaker RMB. I don't think we're all of a sudden going to get capital outflows to the extent that we saw last year, particularly when we look even at the lending numbers that have just been released. We've had a significant de-gearing, particularly in bank acceptances, so trade finance within China, which suggests to us that kind of outflow that's been driven by sort of excessive trade outside China isn't there at the moment. So we don't think there's a one-time devaluation coming. There's probably a little bit more marginal weakness to come as outflows happen, but as people get more comfortable with the Chinese outlook, stability in the RMB may follow.
And what other investment opportunities are there? You say, Douglas, you're looking for companies with a competitive edge. What else are you looking at within China? What can our viewers look at?
So I think SOE reform is beginning to ramp up now significantly. So look at things like Sinopharm, I think, in China is a really important company to focus on as that comes through. SOE reform, we've had two joint companies now merging over the last sort of 3 weeks. So SOE reform is coming through. We've got a large government summit coming up mid-August that we think further reform announcements are going to come from. Chinese banks, obviously they're the classic thing that people hate in China, but I think given the current levels, given the fact that they're currently on about 7% yield at the moment, I think they look like a good investment, considering that we've seen the start of the collateralization of NPLs in China, which was the thing that cleared NPLs during the last cycle.
This is the end game has begun, you say, on NPLs.
I think so, yeah. Well, yeah. yes, and I think it's being missed. But more globally, I think the issue at the moment is, obviously we've seen a huge rotation into high-risk stocks, into cyclicals and all these different things. And while there are various reasons for that, we still are of the belief that it's important globally to look at real competitive advantage stocks, companies that genuinely generate sort of high cash returns, compound those cash returns, and in that kind of environment, the macro shouldn't matter.